What if I told you that a single number could decide whether you get a car, a house, or even a job? That number is your credit score. It's one of the most important numbers in your financial life, but most people don't really understand how it works or how easy it is to ruin. Today, I'm breaking down exactly how credit scores work and the 5 biggest mistakes that can destroy yours. If you want to save thousands of dollars and avoid financial headaches, you need to know this. Let's get started. Welcome back to the channel, where we turn financial confusion into financial confidence. If you're new here, hit that subscribe button and ring the bell so you never miss a strategy that could change your life. Why credit scores matter. Your credit score isn't just a number, it's your financial reputation. Lenders, landlords, insurance companies, and sometimes even employers use it to decide if they can trust you with money or responsibility. A high score can mean lower interest rates, better deals, and more opportunities. A low score can cost you thousands in extra fees, or even shut you out of important opportunities. The good news? You have more control over your score than you think. How credit scores are calculated. Let's break it down. The most common credit score is the fico score, which ranges from 300 to 850. It's calculated using 5 main factors. Payment history, 35%. Do you pay your bills on time? Amounts owed, 30%. How much of your available credit are you using? Length of credit history, 15%. How long have your accounts been open? New credit, 10%. Have you opened a lot of new accounts recently? Credit mix, 10%. Do you have a variety of credit types like credit cards, loans, and a mortgage? Understanding these factors is the first step to building and protecting your score. Mistake number 1, missing payments. The biggest mistake you can make is missing payments. Even one late payment can drop your score by dozens of points and stay on your report for up to 7 years. Payment history is the single most important factor in your score. Always pay at least the minimum and pay on time, every time. Set up automatic payments or reminders if you need to. If you're struggling, contact your lender before you miss a payment. Sometimes they can help you work out a plan. Mistake number 2, maxing out your credit cards. Using too much of your available credit, also known as a high credit utilization ratio, can seriously hurt your score. Ideally, you want to keep your balances below 30% of your credit limit, and lower is even better. For example, if your credit limit is $1,000, try to keep your balance under $300. Maxing out your cards, or even getting close, signals to lenders that you might be overextended and at risk of missing payments. Mistake number 3, closing old accounts. It might seem smart to close old credit cards you don't use, but this can actually hurt your score. Closing an account reduces your total available credit and can shorten your credit history, both of which can lower your score. Unless there's a good reason, like a high annual fee, consider keeping old accounts open, even if you only use them occasionally for small purchases. Mistake number 4, applying for too much credit at once. Every time you apply for a new credit card or loan, the lender does a hard inquiry on your credit report. Too many hard inquiries in a short period can make you look risky and lower your score. Only apply for new credit when you really need it, and try to space out your applications. If you're rate shopping for a mortgage or auto loan, do it within a short window, usually 14 to 45 days, so it counts as a single inquiry. Mistake number 5, ignoring your credit report. Finally, ignoring your credit report is a big mistake. Errors, fraud, or identity theft can drag down your score without you even knowing. Check your credit report at least once a year at annualcreditreport.com. It's free. Look for mistakes, accounts you don't recognize, or incorrect late payments. If you find an error, dispute it right away. Protecting your credit is protecting your future. Common myths about credit scores. Let's bust a few myths. First, checking your own credit score does not hurt your score. That's called a soft inquiry, and it's totally safe. Second, you don't need to carry a balance to build credit. Paying in full is best. Third, your income, age, and where you live are not part of your credit score. Real-life examples. Let's look at some real-life examples. Sarah missed a single credit card payment, and her score dropped 60 points overnight. It took her over a year to recover. Mike maxed out his cards during the holidays and saw his score plummet, even though he never missed a payment. Lisa found an error on her credit report, a loan she never took out. By disputing it, she raised her score by 80 points. Action plan. Start today. Here's your action plan. First, Pay all your bills on time, every time. Second, keep your credit card balances low. Third, don't close old accounts unless you have to. Fourth, only apply for new credit when necessary. Fifth, check your credit report regularly and dispute any errors. Building and protecting your credit score is one of the smartest things you can do for your financial future. If you found this video helpful, hit that like button and subscribe for more real-world money tips. Share your credit score questions or experiences in the comments. I'd love to help. Remember, your credit score is your financial passport. Protect it, and it will open doors for you. You've got this. Thanks for watching, and I'll see you in the next video.